Hi, this is Ashish Shanker, and I'm happy to give you a quick update of the last edition of our Alpha Strategist for the calendar year 2018. I thought this is a good time also to sum up some of the events which happened during the calendar year and give you a sense of what we think will be the way forward. The title of this version of Alpha Strategist is Against the Gods, and I think it's aptly titled. This was a book written by Peter Bernstein, which is a seminal work on risk and probabilities. We thought it is very relevant in today's times where you have multiple news flows hitting your mailbox as well as your mobile phones, and there is lots happening. Typically what happens is that we tend to extrapolate recent events into the infinite future. So what happens is, if we witness a negative event in the recent past, like we had the ILFS credit event, we also had trade tensions between US and China, we tend to extrapolate this negativity in the future, and that hampers our decision making process. Similarly, when things are going extremely well, like December 2017 when markets were on a roll, we normally extrapolate this good markets into the future and tend to make a lot of investment decisions based on what has happened in the past 6 months or a year. This book basically tells us to weigh probabilities of different outcomes and then make rational investment choices. We understand that emotions play a big role when it comes to decision making, but as if you have a good charter and stick to an asset allocation frameworks, some of these emotional biases and investment mistakes can be avoided. But having said that, this has been a roller coaster of a year. Just think about it. The 10-year bond yield, which is currently close to 726, was close to 732 at the beginning of the year. So it's extremely flat. Similarly, the Nifty is actually going to end about 3 to 4% higher this year. Now, if you look at both these numbers, it almost feels like this year has been a non-eventful year. But the truth, that is far from the truth. If you look at how things have moved, it's been a complete potboiler of a story. We started the year with trade tensions between US and China that rattled markets across the board. It also started with Fed indicating more rate hikes than what the markets expected, so the Fed bond yields shot up. Now, due to this, it caused flutters across emerging markets. Our currency started selling off. RBI on the back of it started moving their stance from neutral to calibrated tightening. This led eventually to rates moving up across the board in India, and global rates were the leading indicator for this. So the US 10-year bond yield went about 3%. We further had the credit event in India where we saw one of the leading financial institutions defaulting, namely ILFS, which led to a credit scare across our markets. Liquidity tightened and the rupee sold off majorly to $74. This was aggravated by the huge rise in crude oil prices to about $82. If you see, in the last couple of months, things have completely reversed. Crude oil has collapsed to $56. Global bond yields, namely the US bond yields, have come off to below 3%, closer to 2.8, 2.85. We are awaiting the decision of the Fed, which should come out by tomorrow, and we should also have the minutes. But expectation is that you will see a more dovish Fed. Inflation forecasts have continuously undershot RBI's expectations, and in the recent RBI monetary policy minutes, they have acknowledged this fact, and they've revised their inflation forecast by almost 110 basis points going to the end of this financial year. So we do expect a more dovish RBI, and we also had a change at the helm of affairs at RBI. The new RBI governor has intensified the OMO purchases, and have also indicated 50,000 crores going into the next 3 months of this fiscal year. So as a result, the bond market liquidity has improved dramatically. Yields have come off. Your 10-year bond yield is back to 725, 726 levels. However, the market is becoming more and more discerning when it comes to yields across corporate issuances. So very high quality parentage corporates are getting money again at cheap rates, but NBFCs, which probably have more leverage and have had aggressive lending books, are finding it tough to borrow, but they're also borrowing at higher rates. So it's becoming a very discerning market. Secondly, if you look beyond the Nifty, which is essentially an index made up of the 50 large companies in India, the mid cap index will end about 18 to 20% lower for the calendar year. The small cap index will end closer to 25 to 30% lower for the year. So if you actually go below the top 100 companies, there has been a carnage in our equity markets. But going into the next year, we are going a bit more optimistic because bond yields have come off. So hence, as a result, earnings yield of equities as compared to bond yields are looking much healthier. Money markets have calmed down. There is enough liquidity in the system, and there is a lot of cleaning up which has happened in sectors which are not contributing to earning, namely sectors like corporate banks and capital goods. Corporate banks, you've seen last couple of quarters, whether it is a leading lender like ICICI Bank or even SBI, they are messaging that the worst is over, and they are going into the new year with an expectation of a capex cycle kicking in and the lending book also reviving. So we're going into the new year more optimistic from an earnings point of view. Interest rates are also benign, and crude oil hopefully should give the necessary tailwind from a macroeconomic point of view for India. However, having said that, some of the global issues still persist, like trade tensions between US and China, and we'll see how that plays out. There is a big event happening from a domestic point of view, which is the general elections, should happen sometime in May. Now you saw that in spite of the ruling party losing state elections, market has taken it in its stride, and that is probably because the vote share was not as adverse as the seat outcome. So we are going into the new year reasonably optimistic. However, there could be a flutter in markets closer to the elections, and depending on how the exit poll results pan out. But we are optimistic because the broader market has sold off, the earnings outlook is improving, and interest rates are down. So from a bond market point of view, I think the corporate bond space is still giving people a great opportunity to lock in yields. You're still seeing corporate AAA, AA bond yield portfolios can be constructed around 7.75, 8 quarter, in that range. In terms of equities, you're still getting an opportunity to get in to broader markets at reasonable valuations. So what we advise clients is to lock in bond yields at this point in time in high quality AAA, AA funds. FMPs are also quite attractive at this point in time. On equities, we continue to suggest a gradual increase in equity allocations. However, at this point in time, we feel that clients could make a chunky allocation, because from here on going into elections, we believe that the benign crude prices and benign interest rates should augur well for our equity markets. Lastly, I'd like to reiterate our view that an investment charter, asset allocation led framework will ensure that you will go through these kind of volatilities or these kind of disturbances in a much more calmer manner, and it will help decision making become better over time. I wish all our viewers very happy, prosperous 2019, and wish you all the best for the festivities ahead going into the New Year's Eve.